So welcome everyone to this webinar on Open Regulated Global Payment Internetwork organized by UNCDF. My name is Louis and I'll be your host for today. Before we start the session, a few really quick logistic notes. This session is being recorded and we'll share the recording after the webinar. It will last for about 90 minutes and there will be a Q&A session after the panel discussion. So please use the Q&A option in the Zoom webinar to ask your question directly to the webinar. Now moving to the agenda. As you can see, we'll start with a few openings remarks and then a presentation of the exploratory paper by Arunjay, and then the panel discussion that will be introduced a bit later. So without waiting any longer, let me introduce you to our first guest, Amil Aneja, so the lead specialist for the Migration and Remittance Program from UNCDF. Amil, the floor is all yours.
Thank you so much. Good morning, afternoon, and evening, everyone. It's a pleasure to be amongst you all today. And thank you very much once again, Louis and Arunjay. The nature of work has changed dramatically in the past few decades. Globalization, climate change, and perhaps most of all, the technology revolution have all converged to create a world where fewer people stay in one place working a steady job and more people pursue multiple opportunities. For hundreds of millions of migrants, particularly those in irregular situations, income volatility, uncertainty, and insecurity are part of their lives. Wherever their home or host countries, for most migrants, having access to affordable finance is a major priority. Modern finance has always emphasized the importance of the citizen as customer, saver, investor, and indeed as a political actor. Yet in this case, a migrant has been conceived of as being outside of the functions of the financial system, served by and subject to it, rather than being an active participant. For the billion people who are dependent on migrant money, this could be catastrophic. Digitization can open the way to the migrant becoming a far more active participant in the financial system, in both host and home countries. The digital ecosystem of the future, identification, data, and financial services, enabled by risk-based policies and regulations, must be empowering for migrants to make the most of their talents for the benefit of themselves, their families, and their host countries. As migration patterns evolve with climate change, displacement, and demand for employment may adjust more frequently with the supply, the digital ecosystem of the future for migrants should also offer them the possibility to understand the resultant variability of income streams, the change in expense flows and assets, and the portability of financial products and services, supporting income smoothing and coping with emergencies. But the key to transforming the financial lives of migrants begins from the first transaction in the migrant money experience, an experience as universal as migration itself, remittances. At the moment, remittances are subject to inconsistent policy considerations within a country across regulators and line ministries, with often differing or contradictory regulations between countries, varied degrees of development in the infrastructure around payments and settlements, distinct licensing requirements for who can be in the money transfer business, unique requirements for acceptable forms of identification for senders and receivers, and most important, limited participation of non-banking financial institutions to the national payment systems. All these challenges around remittances, the inefficiency of over-the-counter models, the persistence of unregulated informal flows, the transaction costs, especially in intra-regional corridors, they do require country, regional, and multilateral cooperation among both the public and private sectors to be able to step away from the complexities, moving towards a coherent framework that can allow migrant money to flourish. Easier said than done. Many colleagues who have taken their valuable time for being on this webinar today may either consider this as a repetitive discussion with skepticism, as the situation may be worse than being presented or better than being presented based on where you are and what you have been working on over the years. For some who have been part of these discussions for the last 20 years or so, may also consider this as deja vu, as this may seem like a regurgitated line of discussion, but unfortunately still holding true. I can empathize with both of these positions, having been part of these discussions for some time. Globally, with the leadership of each one of you and beyond, improving access to affordable remittances has been an issue at the forefront since the G8 summit in early 2000s, the Berlin conference exactly 15 years ago, and the various G8 and G20 presidencies over the years, including the G20 alignment with the UN's 2030 agenda to include cost reduction targets set under Sustainable Development Goals. As per the World Bank, and with very generous sharing of the remittance transaction cost data, the weighted average cost and the smart average are already quite close to the SDG targets, especially for the high volume corridors. Thereafter, in 2020, under the presidency of Saudi Arabia, the G20 made enhancing the cross-border payments a priority with an incredible effort led by the Financial Stability Board, CPMI, World Bank, central banks from the G20 member states in particular, and multilateral institutions to establish reasonable targets with pragmatic timelines for 4 identified challenges faced by cross-border payments at large: cost, speed, transparency, and access. As the quantifiable targets have been released by FSB, with also a progress report just last week, we see the operationalization of these efforts with much hope. We have also seen over the years that payments are becoming faster and more efficient, with initiatives such as Swift GPI, with more to come with a wider adoption of ISO 20022 becoming a reality. The growth of cross-border payment infrastructure hubs such as Earthport to start with, and TerraPay, MFS Africa, Thunes amongst others, have further reduced the operational cost of correspondent banking relationships, although not as much on the compliance and pre-funding positions. And finally, there are 60+ IPS today that are critical to digitizing remittances. Many of these IPS systems at the country and regional level are also being interconnected under one of the most impactful initiatives by the Bank of International Settlements Innovation Hub-led Project Nexus. Now, coming to the other side of the discussion, working closely with least developed countries and low and middle income economies on remittance policy and cross-border payments, we do observe significant gaps in the capacity of the countries to meet the steep expectations of technology and business models, needed demand for capacity that accompanies it, and the resources required to invest in payment and financial market infrastructure to enable pathways for private sector to ensure formal financial services are tailored for the low-income population, in particular women and men migrants. Although there is a general acceptance of modernizing the payment infrastructure, we do realize that while inefficiencies in global payment infrastructure need to be fixed, but when it comes to migrants, the challenge of considering migrants as more than a monthly transaction cannot be fixed solely by modernizing the payment infrastructure. Having the digital rails and enabling a regulatory environment that is not exclusive of the needs of migrants will not be enough anymore. We will have to build for solutions that are intentionally designed to be gender responsive and in fact inclusive of the needs of migrants. That is low value, high frequency cross-border payments so that they can be resilient to shocks and allow migrants to be an active participant in the local economies, irrespective of the country. It requires global, regional, and country-based stakeholders in the public and private sectors to consider solutions that drive usage beyond excess and strengthen financial resilience of the low-income population over the long term, in this case, migrants, so that along with making remittances safer, more convenient, faster, and less expensive, other financial services that are vital to cover vulnerabilities and help create assets such as insurance, credit, savings, and in particular pension could also be layered on and linked to the low-value remittances. The efforts being pursued on open regulated global payments internetwork are a step in that direction. These efforts are only possible through wide participation and shared ownership of outcomes, that is, with each one of you. On behalf of the UN Capital Development Fund, I'm deeply grateful for over 50 stakeholders across 30 plus organizations, including G20 central banks, multilaterals, foundations, the public and private sector actors who have been consulted with and have contributed to the vision of open regulated global payments internetwork. Given the slow progress over the last 2 decades, we have also acknowledged the apprehensions that have been shared through this process, some of which I hope we can surface today. UNCDF remains committed to continued and scaled investment in supporting the G20 cross-border payments roadmap targets, but while also ensuring that the challenges of operating in the least developed countries and the voice of migrants as viable customers of an inclusive financial ecosystem are taken into consideration always. I'm very thankful to the panelists for their time once again and sincerely appreciate the participation of all those joining us across different time zones. Thank you, Louis, and over to you, Arunjay.
Great. Thank you so much, Amal. I wanted to start with a story. Typically, we look at remittances from an aggregated view, whether it is from the US to India or from Singapore to the Philippines. High volume corridors are abound, and we also have other corridors that are less frequent in volume. But moving from that aggregated view today, I want to zoom in to look at what it actually takes to transfer money from one part of the world to a remote part of the world. So we're going to this webinar are bona fide experts in digital financial services, and a friend of yours has come to you and has asked for your help. So you graciously accept. You're living in the United States, and you're helping your friend send money. Now, what if you're not sending money to Mercy in Kenya or Mamadou in Dhaka, two relatively easy places on the African continent to get to? But what if your recipient is in a remote village called Yekua in Niger? This is where your headache begins. But you are undeterred, and you start by reaching out to your recipient who is working in his village's chronically under-equipped pharmacy. Now, he has a smartphone, thank God, and he has WhatsApp. So you start by reaching out and asking for the local cash out options. You quickly receive a snapshot where you get the options. The first two are money transfer services in Niger, and whilst they offer international transfers, those are only for the French CFA region. So a practical dead end for you. The third, BNIF Afua Bank, is a local bank, but not even a top tier one. You know that the corresponding banking system is cumbersome and expensive, and you have no way to know if they're even on the SWIFT network. So mobile money looks to be the best option. Zemani is a subsidiary of Orange, and you know from previous experiences dealing with French banks that this is going to be a uniquely frustrating can of worms. Airtel, on the other hand, is Indian conglomerate, not restricted by European banking laws, and you feel you might have a better chance. So needless to say, you can't Zelle your money from a Bank of America account to Niger. It just doesn't work, at least not today. So your next option is to download the Airtel app. And once you've done that, you realize that you need a local number to activate it. Now, the problem is you find out that to get a local number, and you need to use this app locally. So therefore, this now is another dead end. So being in the know, you go to a price comparison website, Monitor, you search United States to Niger, and you come up with WorldRemit. Great. But you are disappointed to find out that WorldRemit has discontinued their services to Niger. Back to square one. Now, you've heard up and coming things about Chipper Cash and fintech funded to the tune of $300 million. But unfortunately, they don't do transfers to Niger either. So at this point, you could throw up your hands and go for the tried and tested Western Union. But the fees to this remote village in Niger are high, and the distance to the nearest agent for your recipient is far. So you fiddle with Google search parameters, and you come upon EasyPay. Now, you've never heard of them before, you know nothing about them, and quite frankly, this is your only lead. You do some basic due diligence, being this bona fide expert and all, and you find that the founders are Indian, there are no red flags, and so you say, okay, let's give it a go. So you carefully piece together the different pieces of the puzzle. You then send the money from a Visa card to the EasyPay platform, from EasyPay to your recipient's mobile wallet, Airtel wallet, and then your recipient can cash out. So it's for just under 10%, you have managed to do an end-to-end transaction, which costs 3% to upload the funds, 3% to transfer them, and then 3% to cash out. So for just under 10%, you've done this transaction. And as you bask in the glory of having done it, you ask yourself, how many migrants would have the resources and the patience and persistence to do what you just did? Now imagine if each email you had to send today had a different pricing structure. And depending on who you were writing to, the cost would go higher the poorer your recipient is. Well, This is the state of money transfer today. But equally, phone calls, text messages, and emails are completely interoperable. It wouldn't be very helpful if one mobile network couldn't call another. Equally, it wouldn't be very helpful if emails could not reach other internet service providers. And so the foundations of interoperability exist and have proven to be very effective. So we asked ourselves the question, why can't we send money the same way we send an email? And that led us down the path to come up with some ideas, and also equally through our consultations find that we weren't the only one thinking about this. So our vision is really to be able to send money to anyone, anywhere, just like you can a call, a message, or an email. In August this year, we published an exploratory paper that highlights our vision. We look at, today what we have, which is in many cases slow, expensive, fragmented, and non-transparent, and a situation that is quite frankly unsatisfactory for all. So an open, regulated global payment internetwork is one that sits above all existing networks by connecting them. So this isn't a new network. It is one that would connect existing networks. So the likes of SWIFT, Visa, MasterCard, and other existing networks, along with the challenger networks such as Ripple, Cello, Stellar, as well as new networks, and including Project Nexus, which is connecting both domestic and regional instant payment systems. All of the existing networks can be connected. And this would mean, going back to the email analogy today, payment networks are connected, but not in an interoperable way, such that in an email, if you could only send emails to those with .com addresses, versus if you had a .org email address, you could only send emails to those with .org email addresses. So that's sort of where I would say we are. So our paper has three main phases. The first is account addressing. It's a global directory that would identify proxy or alias, payment aliases to reach account numbers. Now, in India, an instant payment system was launched in 2011, but it was only with the advent of the unified payment interface in 2016 that instant payments really took off. And what that did was it provided an address, and in most cases it was a mobile number that was used to identify the recipient. Similarly, in Brazil with Pix, you could use one of four identifiers: a phone number, email address, a tax ID, or a QR code. And again, it similarly has seen a huge amount of uptake. The second phase is compliance, tokenized compliance. So we believe that to reduce the cost of remittances, compliance is a key factor. And the third part is instant clearing and settlement, where real-time settlement is something that reduces the cost of liquidity and foreign exchange exposure for the money transfer companies. Our vision is consistent with that of the G20 roadmap for enhancing cross-border payments. And those of you familiar with the building blocks will know, those blocks. So phase 1 corresponds to building block 16, which is establishing unique identifiers with proxy registers. Phase 2 is connected to building block 8, which is fostering KYC and identity information sharing. And phase 3 is building block 19, which is the factoring international dimensions into CBDC design. But equally, it need not require CBDC, and I'll come to that in a minute. So the account directory that I mentioned as phase 1 will connect existing financial service providers who currently provide mapping services. So these directories exist. They are in many parts of the world. And the global directory will aim to connect them in a federated manner, where each of the directories maintain their own information. And when a request comes in, they would validate the alias and the account name, return the legal entity identifier, which will be used to identify the recipient's bank and the payment systems the recipient's bank is part of, such that a payment can be made through one of those given systems. And this will work on a zero knowledge proof basis, which just means that no information, like personally identifiable information, will be returned. It's only a validation or either positive or negative. In terms of the tokenized compliance, which is phase 2, today compliance has to be done by every party in a transaction. Typically, there are 4. One will be the sending, and the other the receiving, and 2 intermediaries in the middle. The cheapest cost to do a compliance check is about 50 cents, which means that's $2 of compliance cost. And that's for every single transaction. So no wonder a $20 transaction is pretty much a non-starter. Now, in a world where today these transactions, the compliance is done by one of 4 or 5 global compliance houses, we could see a future world where one of those trusted providers signs a token which shows all of the different checks that were completed, and that token then passes along with the transaction for each of the intermediaries to see what has been checked, do additional checks if they need to, and based on their risk assessment. But this could potentially reduce the cost substantially. And finally, the instant clearing and settlement is a world where we see the money that you send is the money that your recipient receives. Today, funds are paid out from a pre-funded account, an account that your provider has purchased currency for in advance. And the problem with that is that there's a huge cost of liquidity as well as FX exposure, because typically we're sending money to emerging markets whose currencies rarely appreciate against the US dollar. So providers who park funds ahead of time have to manage this exposure, which ultimately gets passed on all these costs get passed on to the end user. So with the challenger financial market infrastructure players such as Finality and RTGS Global, we're starting to see the potential for real-time settlement to occur even before CBDCs come to fruition. Now, just very quickly, in terms of what we've done so far, we had consultations, as Amal mentioned earlier, with over 50 stakeholders. We held a workshop in July this year. We had attendees from SWIFT, Visa, MasterCard, the Mojaloop Foundation, TerraPay, and the BIS Innovation Hub, as well as the Bank of England. In August, we published the paper I just mentioned, and later this month, we're aiming to publish a technical paper on phase 1. We're also aiming to be included in the progress report for building block 16 that is also due out by the end of this year. And in terms of next steps, we're looking to secure commitments from key stakeholders to conduct a proof of concept pilot for phase 1 early next year. So in summary, our goal is to speed up total interoperability, allow users to use an easy to remember proxy alias to identify an account, and to reduce cost by improving compliance and liquidity and improving the overall infrastructure. At this point, I would like to introduce our panelists, and we will then move into the panel discussion. So we have Sabine Mensah, the Deputy CEO of Africanenda. Before joining Africanenda, Sabine served as the Regional Director for UNCDF and the Regional Director responsible for domestic and international remittances at Western Union in Canada. We have Elizabeth McQuarrie, who's been a partner with Glenbrook Partners for 12 or so years now. Elizabeth has a very interesting background because she worked at the Fed in the US, the Federal Reserve in Atlanta, and has seen this problem from multiple sides, from both the private sector and the public sector, and so brings over 20 years of experience to this discussion. Ryuichi Ono is from the Japanese Financial Service Agency, and he has over 25 years of experience in systems design in particular, and having spent the last 5 years in financial services. He joined the JFSA to lead the international office and leads building block 16 for the G20 roadmap. And lastly, we have Mohit Tewar, who's been at the forefront of remittances for a very, very long time. Mohit was involved in one of the first electronic transfers, I want to say back in the 90s, and has worked with the likes of MoneyGram and several other blue chip organizations. And in his own words, Mohit has now gone rogue and joined the crypto world. So this, I welcome all of you. Thank you so much for joining us. Mohit, I want to start with you. Last week you mentioned the more we digitize remittances, the more we push people towards a behavior that is counterintuitive to what the cross-border payment rails are geared up for. Can you expand on that and also talk about the tension between the two?
Thank you, Aranjan, and thank you, Emil, for the invitation. I guess I have a habit of putting my foot in it, so let me try and explain myself. Look, I think let me just from the outset say that I think digitization is the right direction to take because of the various long-term benefits. So there's absolutely no dispute there. But I think there are a number of issues, and I'll try and pick on a couple. So I think one of the benefits clearly that we want to achieve by digitizing remittances, payments in general, but let's talk about remittances, is the convenience aspect of it and change the behavior that it brings, which is, and what do I mean by that? Perhaps send smaller amounts and more often for specific family needs rather than once a month or twice a month that has been the behavior for decades for the migrants. And also bill payment, which is becoming more and more popular. But this is only possible if the cost of doing these frequent remittances or payments is reflective and commensurate with the convenience aspect. But for a transaction, every transaction that takes place, you touched on some of this, you've got KYC costs, you've got pre-funding costs, which is effectively liquidity costs, you've got legacy commercial arrangements in place. So there's a lot of friction that exists that doesn't easily translate to enabling and encouraging this sort of behavior of little and more often. Also, there is no such thing as a global RTGS system. So while we do have some very efficient local systems in place, and by the way, not all of them are that efficient and still face challenges. I mean, just on a slightly different tangent, but I have to pay my Citibank credit bill that falls due on Monday in Dubai. It's a national day long weekend, and I made the payment yesterday because I forgot about this long weekend, and now I'm not sure if it's going to get there on Monday or not, which is the date for the payment, because I got a notification from my bank saying, well, they'll approve the payment when they open. So this is, and look, this is a local payment, right? Bring into it all the clunkiness and the friction that exists for a cross-border, but that's just one example. So there's no international cross-border RTGS system that exists. So you've got the challenges with legacy arrangements, you've got correspondent banking issues in place, and so on. So that's really what I meant. And then if you add to this that the receiver perhaps is unbanked, then you've got all the last mile issues, while you may have digitization on the send side. So I think, while I think this is exactly the right way forward, what I meant by that statement was that while we're pushing this digitization agenda, let's sort of tackle these other issues and with a holistic approach, that go well beyond, identity, KYC, rails, policy making, local systems, and then of course we'll achieve that statement that you made that sending payment should be like sending an email or a text.
Great, thanks, Mohit. I think you really nailed it on a few counts, and it really is frustrating that the friction are such, and as you mentioned, the credit card payment, and what happens now if you miss that is you get then charged with a fee, plus also you lose your 50 days of interest period, which means you're incurring interest on all of those charges. So it's a real mess, especially right. If you miss such payments. So certainly hopefully we can get to this world where it's seamless. Sabine, I'm going to come to you for the African perspective. Africanenda recently published a report stating, which is the state of inclusive instant payment systems. So please share some of the key insights as well as the current challenges.
I hope you can hear me well, Aranjan.
Yes, yeah, absolutely.
Okay, wonderful. Hey, I would like to thank you very much, Emil, and the UNCDF team for giving me the opportunity to be on this panel with my co-panelists. And you're right, we through the research we did on instant and inclusive payment system in Africa, a lot of findings. I think for us, even the reason why we did the research was that it was difficult to find aggregated information on the IIPS in Africa, or instant payment systems in Africa. So, but I have to tell you, the findings of the report, it's clear. I mean, instant payment is in Africa and has been thriving. We've actually seen a dramatic growth in IIPS systems. In 2002, we saw about 2 of these systems, and now we were able to see 29 in a landscape of active systems up to June 2022. So 26 national domestic instant payment systems, and then 3 regional instant payment systems in Africa. So it's and when we look at the different stage, you also have about 21 of these instant payment systems in development, but 18 of those are domestic and 3 regional that are coming. So the regional ones that are active include GMAC Pay in Central Africa, and you have TCIB in the SADC region, and of course you have PEPS, the Pan-African one on the continent. I think also some of the learnings, while in the past there are siloed systems, we see a lot more of the cross-domain instant payment systems where you have some level of interoperability between banks, mobile money, instruments. So I think you'd mentioned interoperability in the study, and when you reflect that from a cross-border perspective and remittances, it's true that this remains a challenge within the continent, and even for some of the regional instant payment systems that are ongoing. And at the end of the day, I think it's also a question of providing the right value proposition. Nevertheless, what we've seen in terms of the size of that market, about $1 trillion in value were transacted in 2021 through 16 billion transactions into the instant payment systems that we were able to landscape for 2021. So that it is clear that instant payment systems are here, and they're here to stay. But it's not all rosy, if one might say. Interoperability still remains an issue and a challenge into the ecosystem, particularly when you're looking at it from a cross-border perspective, but also at the national level. And the governance of the systems in terms of the participation of all the financial service provider, regulated financial service provider or licensed payment service providers, the playing field is not that level or that inclusive, if I might say. So we see a lot of the system driven by both central bank and commercial banks. And while there are trends in including more of the fintechs or non-bank financial service providers, they are not necessarily into the decision-making process. A couple of the trends that we've seen confirm what you've seen also in your report is, standardization is important. A lot of a movement toward the adoption of standard messaging standards, ISO 20022. Although from a cost perspective and for those who have legacy systems, it is a challenge, and there has to be a willingness to make the investment or use some type of translation while the partners are moving towards that. So that is definitely a theme that we see. And I think also you've mentioned the issues about compliance, and through this research, for instance, for us, one of the things that we've seen, and that's is a challenge for cross-border and regional systems, is particularly with regards to eKYC, whether a country enabled eKYC, another one doesn't. How do you do instant from both sides of the transaction? So there is an impact into the speed of the transaction as well. And of course, from our perspective, we're really focused on low volume payments, so cost remains a factor for the consumer in terms of affordability, and that plays a role into the adoption of these systems as well. So a lot of it shows for us an opportunity to work on policy harmonization also to enable these instant payment systems to be inclusive, but I'm happy to focus on the question about inclusivity when the time comes. Back to you, Aaron.
Great. Yeah, thanks so much, Sabine. It's a fascinating report, and we'll share a link of that, in the chat for those on the webinar. Ryuichi, I want to come to you next. Looking at cross-border payments from a global perspective, can you please share the progress on the G20 roadmap, including the current priority?
Okay, thank you, Arjun, and for introducing me. And actually, it's my pleasure to have to take part in such a good opportunity. And about the G20 roadmap, and as Amir mentioned in his welcome address, and the G20 has made enhancing cross-border payments a priority, with the goal of making such payments faster, cheaper, more transparent, and more inclusive, while maintaining their safety and security, and protecting the integrity of the global finance system from its activities. And in November 2020, the G20 leaders endorsed the roadmap to enhance cross-border payments, developed by the Financial Stability Board, that's FSB, in coordination with the Committee on Payments and Market Infrastructure, that's CPMI, and the other relevant international organizations and standard-setting bodies. And the roadmap is structured according to the 19 building blocks, which span 5 focus areas, which I don't explain the details today. But the G20 also endorsed quantitative targets for 4 challenges: that's cost, speed, and transparency access faced by cross-border payments in October 2021. And the target has been set for 3 market segments, and that's for sale, retail, and remittances, and will be used for monitoring progress, maybe from next year. And so much has been accomplished during the roadmap's first 2 years to establish the foundational elements for practical projects to improve existing systems and develop new ones. And having reached an inflection point in the work now, and the FSB, in coordination with CPMI and other relevant international organizations and standard-setting bodies, are beginning to develop a set of practical projects for the next stage of work, organized around 3 priority areas. And that's the first one is payment system interoperability and extension, and that includes improving direct access to payment systems and extending and aligning the operating hours, and also pursuing interlinking of payment systems for cross-border payments. And the second one is a legal, regulatory, and supervisory framework. And that includes not only just aligning regulatory, supervisory, and oversight frameworks, but also applying AML/CFT rules consistently and comprehensively. And the third one is a cross-border data exchange and message formats. And that includes reviewing the interaction between data frameworks and cross-border payments. And it also includes adapting a harmonized ISO 22022 version of message formats and harmonizing API protocols for data exchange. And strengthening the engagement and the partnership with the private sector is considered to be the key element of the next phase of the roadmap, and engaging a wide range of public sector authorities from jurisdictions beyond the G20 is also considered to be important. So considering those points, SSB will coordinate work to develop the further details of the actions of the next stage. And thank you.
Thank you, Ryuichi. Yeah, next, Elizabeth, I would, sort of, we've seen some of the challenges. You've been in this industry for such a long time, and so you've seen these challenges right across the board. I would like you to share some of your what gives you hope today? Why should we believe this could be possible?
Thank you, RJ, and really appreciate the invitation from UNCDF. And we have so many great ideas here under discussion today. And honestly, there's a lot of very positive developments in the industry, right? We are making incremental progress. We are at the same time not where we want to be, particularly in terms of the impact that is ultimately had for low-income users, and in particular migrants who are in such a more, if you will, vulnerable situation regarding access to the payment system. And I truly believe that we have really moved to a new phase of conversation here. That when I first started in payments, which was 2002, there were tremendous sort of mismatches of systems. We didn't have, ISO 20022 was only an initial part of the conversation, or any other sort of shared standards where, we had our national standards, we had our national payment systems, and everything was very much islands, right? And the distance between the islands has really minimized. And of course, speed is a reality. We also are able to put all of this together. And my point is really that the challenges are no longer technology. I think that the challenges for achieving the goals that we're talking about here today are largely about cooperation, and in some ways, and I use this term broadly, it's about sort of alignment and governance, right? That we're getting into the more qualitative aspects of choices that we make, rather than, the quantitative issues of, how do we connect our technologies and what is the cost of that? So fortunately, we can really focus on these more qualitative issues, but in some ways they're also very, very challenging, right? And I think that what we've really, with the recent paper that RJ led, really points out to us is that, there are 3 areas that can make a lot of progress. And I'll just remind us, sort of interlinking of account and addressing directories would facilitate end user use. Tokenized compliance, or a compliance token that could be shared end to end, is one that would have a lot of value, right? So reduce the number of times that an individual needs to be validated in the system, and instant clearing and settlement. And aspects of, parts 1 and 3, so the directory and the instant clearing and settlement, really exist today. They're not everywhere, they're not universal, they're not ubiquitous, but we have instances of that. It's the compliance aspect that I think is the most challenging, and is perhaps where we really need to be putting our emphasis in trying to sort of reduce this problem, or how significant the problem is, because that is the one that I'm not sure that we have any real examples of where this is working, certainly on a cross-border basis, right? Because our compliance credentials, our compliance processes, they pretty much start and end at every border, right? So we're not sharing of that information. And how do we put all of this together? And that I think that, there's, again, a lot of progress that we can build on. And really, in the end, I think that we're really getting down to trying to determine, the cost of providing the payment services, and lowering that on an end-to-end basis for cross-border payments. So much has been achieved on a domestic basis. We know a lot of the factors that enable the lower cost provision of payments. You know, we're making tremendous technology gains. Just for fun, I'll share that when I joined the Federal Reserve, 20 some years ago, just basically the cost of moving data was an issue, right? And that fortunately is no longer a primary challenge, right? So we don't have to worry about the cost of moving the data, but we do have to worry about the overall cost of providing these services. And at the same time, we have the costs about the ability for migrants to access the system. And that also starts and ends at each border, right? We make advances with eKYC in some countries, but of course that the lower level of compliance on a super low value payment in one country is no longer relevant when we get to the next border, right? We don't have a fundamental agreement on that. And that is, again, a hindrance to, I think, lowering the overall, the ability to lower the cost on an end-to-end basis. And at the same time, we are lowering costs, but of course, there's a lot of pressures, right? Financially, particularly for the low income, and inflation is, of course, a reality for everyone now. And we also just have affordability issues. We're starting to see, I think, very unexpected conversations around this issue of affordability in payments, in the sense that, perhaps not every payment should be priced, right? This is the fundamental, I think, learning from PIX in Brazil, that consumer payments, and then they've said all consumer payments, not just ultra low value ones, are, that they're not priced, right? They're free to consumers, if you will, not priced to the end user. And we see what the tremendous pickup is. If anyone thought that instant payments weren't going to have a pickup in the short term, all you have to do is look to Brazil. Of course, this puts us back at our ecosystem, right? So there are costs to the financial institutions in Brazil. They are looking at this now based on the regulatory environment as something that they need to produce as an adjacency with other services. It's not the end all itself, the payment. And so that's a very interesting perspective. And I'm sure that every financial institution does have to look at this and figure out how to place it within their ecosystem. But on a sort of national level, Brazilian banks had their most profitable year ever in 2021. So providing free payments to consumer account holders is not an impediment here, I think, is the big takeaway from Brazil.
Absolutely, yeah. And I think, it's similar to the Google and the various other asymmetrical models where something is free and the other thing is priced. Elizabeth, I wanted to touch on something you said, which is, so 1 in 3 is happening, and I do agree, but 2, we have very little to show for. There was, some initiative in the South Pacific, which is kind of on hold as I currently understand it. But one of the things you told me the other day was that, the regulators were kind of stepping up, and, the BIS Innovation Hub, one of the things you said was that you're, struggling to keep up with the different code names for the various projects that, keep coming out of the different innovation hubs. I just thought maybe you can share a little bit more on that.
Yeah, I think it's fantastic that the regulatory community in general is actively addressing or trying to tackle these issues. And there is a tremendous amount of focus right now. And I do believe that, that will have a positive effect. Of course, at the same time, I think we have to also start thinking about some of these more intractable problems or seemingly longer term problems, as we just discussed about compliance aspects. Are there things that we can share that can meaningfully address the cost of compliance? There are, I've been involved in a number of industry initiatives to lower the cost of cross-border payments. Some of them looked a lot like what Project Nexus is described as. And even though maybe each of them did add something or achieve one aspect, improved concepts, that none of them have been as successful as the idea of Project Nexus. So many other countries are aligning behind this. Of course, now we have instant payment systems, which can be potentially connected. We're starting to see examples of that. But I do find it challenging to think that we're really going to achieve the progress that we are discussing unless we can also bring into the conversation some of these more qualitative, challenging issues. And this is perhaps how peeling back the layers of the onion, finding out where the real challenges are, right? And these are my views. I'm sure not everyone will agree, but I think there's definitely something to focus on here.
Great. Thanks a lot, Elizabeth. So Mohit, I wanted to come back to you on, in February 2019, you wrote a paper based on de-risking and liquidity. These are challenges, the industry continues to face today. And, I would like you to elaborate on them, and also why central bank intervention is critical.
Yeah, I think a number of you have heard me, talk about the two sort of big challenges over the years, both in terms of de-risking and liquidity, which is basically the need to kind of fund your payout partners. And that's more of an impediment to growth, right? So the more you grow, the more liquidity you need to be able to do that. I don't want to make this a de-risking sort of focus, which, as you know, I don't need a lot of encouragement to talk about de-risking. But basically, I think just very fundamentally, I think everybody understands that de-risking is just the denial of, domestic banks to offer remittance companies in particular, as we're talking about remittances, access to banking rails. But this really stems from the US dollar correspondent sort of arrangement. So if you have to settle in US dollars with most transactions, then you need to go through the clearing banks in the US, and that affects. And by the way, this is a global phenomenon. I don't think from Western Union down, anybody's been immune to it. It just has affected, obviously, smaller companies more. And liquidity we touched on in terms of an impediment to grow. And that's quite important, because if you think about, Elizabeth was just touching on cost, which is very important. But one of the key ways to bring costs down is to promote competition and innovation. And, if you've got liquidity as an impediment, not everybody has deep pockets. So you've got these startups and they can't sort of fund the liquidity, so they can't grow, which means costs don't come down because you've got concentration of volume within a few players, and then they can choose to basically monopolize it in some way. So I think those were the two issues. And when I wrote this, and it does seem a long time ago, I was really trying to address those two issues, but I was trying to use blockchain and digital assets as a way to address this. And I want to emphasize, as much as you said, I love crypto. This wasn't about crypto. This was about using a token to basically transfer value from two parties that were transacting on a blockchain. And where the central banks really played a very crucial role was, in most countries, they're the common regulator. So a central bank will regulate the banks, and they'll typically regulate the remittance companies. And so if you have the remittance companies also connected to central banks where, they could basically, using the local rails, as we've said, those in most cases are more efficient than the cross-border rails. So a remittance company A would basically settle with their local central bank, and there's a degree of trust that exists by and large between central bank to central bank, and then the receiving central bank would know that the sending central bank has cleared funds, and then they would, through the local rails, make the receiving payout partner good. So then that would eradicate, in my sort of world, the need to go through US dollars and also to go through cross-border liquidity. And that was really the genesis of trying to bring central banks into it. Now, you don't need blockchain for that. You could do it through a general API connection and various other rails that exist. But I think that just one other point, why it's also important to recognize, why do remittance companies exist, right? I mean, if the banking rails were so efficient, you'd have to ask the question, why do you really need the remittance company? If you sort of put aside the fact that most banks don't want to touch the migrants, but let's sort of put that aside for a second. The two components in any payment are value and information. And the remittance companies have established this global network, bypassing the traditional payment network, that basically allows the information to flow instantaneously. So, if I went to my local post office, which happens to be a MoneyGram agent or whatever, and I sent you money, information would go straight away to the receiving agent that says, pay R&J $1,000 or whatever it is. But the value still needs to move through the banking rails. And that is where, that intersection of the two still causes a lot of friction. And that's where I think central banks could play a big role, because I agree with what Elizabeth said. Technology is no longer an issue. In fact, I'm coming across solutions every day that are looking for a problem to solve. So technology is already there, but we need to bring the various constituents together to have that willingness to address that issue. And that's really what that paper was trying to do.
And I think someone at the Bank of England must have read your paper, because in 2021, the BOE launched the Omnibus account, which, Finality is now the first to acquire. So perhaps more will follow.
I would not take any credit for it. I think they probably got there, and I think that's great, and I think we're starting to see more and more central banks. I mean, look, there were initiatives that, I remember happened within UAE in China a long time ago, which was to sort of, bypass dollar as a settlement currency. The challenge you also have is that central banks are not commercial banks, and so they don't play that role for these micro payments. They may do it for big trade payments and country-to-country settlements. But I think they could really step in, or they could nominate a commercial bank to step in as well and play that role.
Absolutely. I think it's fascinating times. And I think in 2023, we should start seeing some of these challenger FMIs going live and starting to do those transactions, which will give us even more insight into how this could all work. Great. Thanks, Mohit. I think, Sabine, I wanted to come back to you. In the state of the instant payment systems report that you were mentioning, one of the things that is highlighted are the many flavors of IPSs. But so that's interesting to see all the different ways. And I'm not asking you to go into that, but what I would love to hear is, and I think our audience would really benefit from, is what is the difference between an IPS and an inclusive IPS, as the IIPS that you call it? That's something that's really relevant to low value.
Well, thank you very much for that question. And I could see Elizabeth smiling, same time I was smiling when I'm listening to your question. But maybe before even I go there, I wanted to really comment on what you'd said, Elizabeth, with PICS and the fact that payment rails could be a utility that will leverage to get more people into the digital ecosystem, and hopefully, coming back to Mohit, put an ecosystem and a governance mechanism that really encourage competition and innovation so that more transformational services are available to these consumers to have access to land and credit, insurance, savings. So the financial inclusion journey is not just at the payment piece, but we at Africanenda foresee that payment rail gateway, if we take out that access a challenge there, maybe we can help foster that ecosystem, whereas working with the different regulators, we can incentivize innovation. And you've also mentioned the fact that for PICs, yes, the payment piece at least is at no cost, and the fact that they've developed also a lot of the use cases in one shot and put it out into the market, while what we're seeing in Africa is that a lot of the IAPSs are taking a stepped approach and typically will focus on P2P as the first use case, or P2B as the second, and then hopefully as time goes and investments are coming, or the use cases are coming in. I want to stress the value proposition, particularly for the consumers. And if we're talking for us, the most vulnerable consumer, the poor, how do we make sure that we are putting a value proposition that competes with cash? Because at the end of the day, that's the competition is really cash. And if there are incentives into that ecosystem that can really take out the cost frictions, at least for onboarding people into the payment rails, then perhaps there are opportunities to gain that later on with more massive adoption of our payment system. And while we were doing the research, so coming back to your question, we've struggled ourselves in saying, yes, we have instant payment systems. And in my mind, it's that, you can use you can make a digital payments. You can use, let me say, as a consumer, my most basic phone. I am in rural Senegal. You mentioned actually Niger. And in your story at the beginning, if I was, one of these people in a rural area with the most basic phone, I'm not sure I will want to have, a SIM card with any of the different providers just because I can do transactions there, because interoperability is not there. So that becomes something that we looked at saying, yes, you can have an instant payment system, but if the ecosystem is not there, right, if the functionalities, the channels that are being used, the use cases that are enabled are not providing optimal, adoption, then there's something to be said between instant payment and instant and inclusive. Instant payment, at least from that perspective, we're really looking at, being able to do convenience for 24 hours a day, 365, as instant as possible or near real time as possible for this transaction. But we've come up with what we call for us a spectrum to look at inclusivity. And through that spectrum, what we are really focusing on is, what are these channel and use case functionalities, what we call inclusive functionalities. So how far do we go to facilitate that adoption journey? And we're also looking at the governance and saying, how far can you go in terms of inclusive governance? So for us, there are 3 basic levels of inclusivity in that spectrum. And at the most basic level, we hope that these systems, these instant payment systems, are indeed leveraging opportunities for the most used channels to be supported, and that at minimum, they provide P2P and P2B use cases. That basic level of means inclusivity. And as you move towards the spectrum, for us, from a progress level, you need to have, interoperability all to all. You need to have participation of all licensed, payment service providers have access to the scheme, but they also have equal input opportunity to the decision that the schemes are making. And I know Mohit earlier had mentioned on the role of central banks, and for us, it is important, and we've seen a lot of central bank coming in and bringing that pro-poor governance perspective, that inclusivity mandate into the ecosystem to be able to bring all competing commercial entities into the ecosystem and really putting an incentive for interoperability and business model that will benefit the poor and make services as accessible. So for us, the progress level is really leveling the playing field with, all PSP's participation and input, but also, ensuring that there's this interoperability all to all, and the central bank is really involved into the governance of the scheme. What we haven't seen when we're doing the landscape in Africa is what we aspirationally call mature level of inclusivity. And at that level, we're saying, your use cases are a broad range of use cases are enabled. To give you an example, when we did the study, we saw a lot of P2P, P2B, But on the 29 systems that we've seen active in Africa, only 7 of them had G2P enabled. While we know G2P can be an incentive to bring, most vulnerable into this ecosystem through, social payment schemes, for instance. So expanded use cases, important to get to that mature level, and hopefully all of the use cases are enabled, which PIX has done, which is great, and we can see the results that they've had. And also on the governance side, we think it is important to really focus on the consumer and provide a consumer recourse mechanism that's transparent, so consumers know when the system doesn't work, where they need to go and what actions would happen. And also bringing that mandate in terms of low cost for end users, so no minimum, transaction value that's there. All of these contribute to bringing a level of mature inclusivity that we believe can accelerate the financial inclusion journey in Africa and throughout the digital payment ecosystem. So hopefully I've answered your question.
Yeah, very, very much. And I think the key things I heard there was the participation, getting not just, the top tier banks, but everyone in the ecosystem participating. I think that was a key one, and some countries are doing better than others there. Great, thanks so much, Sabine. So, one of the things that, like phase 1, we talk about the proxy addressing, and we've now had a number of mentions with PIX being able to do that, and mobile money in general has also done that really well with, just the mobile number being the de facto account number. People are able to do those transfers, and so at this, I think I want to come to you, Ryuichi, to get a little bit of an update from building block 16. Of the G20 roadmap. Can you share sort of what progress has been made?
Okay, thank you for your question. And as Alan just mentioned in his presentations, BB16 is moving towards the task to establish unique identifiers with proxy registries for action items of the G20 roadmap. And regarding to the unique identifiers of legal entities, and we published a report named Options to Improve Adoption of the LEI, in particular for use in cross-border payments in July this year to 2022. And the report set out the recommendations for promoting the use of LEI in cross-border payments, and the FSB published progress report by the end of 2024, together with a review of progress in implementing the recommendation. And that's future work. And then we turned to drafting a report named Developing a Global Digital Unique Identifier for Cross-Border Payments. That's based on outreach to authorities and the private sector. And this report explores the benefits and risks and operational challenges and the potential approaches involved in the development of the global digital unique identifier, that's a GDUI framework, focusing in particular on natural persons. And also this report analyzes the potential advantages and the disadvantages that the decentralized proxy registries may bring to GDUI framework. And this report, actually informed by outreach to authorities and the private sector, assumes 2 primary potential use cases for GDUI. And the first one is to people payment processing and routing, and that's a potential streamlining and identifications of payers and payees, and that's reducing and processing errors and the need for complex conversion of data. And the second use case is to facilitate the customized identification and verification of identity that's to support CDD1, AML, CFT, CPF, etc. And we recognize that there's a potential benefit, but we also recognize that there are significant challenges to tackle especially to develop DDI for second use case that to facilitate customer identification and verification of identity. And those are arising largely from inconsistency of the regulatory frameworks and the privacy policy among jurisdictions and the international standard executive bodies. But this report does not analyze how identifiers could fit in possible DDI framework involving proxy registries, which will be needed to be addressed in the future as a future work. And so considering the difficulties to align the regulations of privacy policy of jurisdictions in a short time, I personally think that it's realistic to start from bilateral or regional alignment. But even in such cases, I think it's important to adopt the standard, as RJ mentioned in his paper, that preparing the future expansion from bilateral to trilateral or multilateral, and eventually leading to broader alignment. And this report is now in the review process of the FSB and will be published by the end of this year. Thank you.
Great, thanks so much, Ryuichi. We look forward to reading the report when it comes out at the end of the year, in end of this month, I assume. So thank you very much for that. And so, Elizabeth, I have a question that I think is one that might be on the minds of others as well, which is, what are some of the challenges and the risks that stakeholders face when linking domestic IPSs, to cross-border payments? So we've seen that Singapore Fast has connected to Prompt Pay. I believe that Fast is, sort of Pay Now in Singapore is connecting to UPI in India as well, and other such initiatives bilaterally are taking place. So if you could just share some light on that.
Yeah, absolutely. And I'd love to learn in more detail about, what is happening in the ASEAN region and how they're enabling these, because I don't know the specific details, but certainly in principle, when we're talking about cross-border instant payment connections, that there's two challenges that I think are quite relevant beyond whatever other, sort of connections, interlinking, interoperability of domestic systems. But obviously, speed is the point, right? So with that in mind, how do we, inform the consumer what the foreign exchange rate will be? That's often a requirement, and then ensure that those funds are, if you will, good to the providers, right? So if we are doing a instant foreign exchange conversion, where are those funds sitting, and what sort of provisions do we need to take? That's a relatively smaller problem, but it's a concern. Nonetheless, doing that instantly. And then I think the larger problem or challenge in my mind is the sort of compliance that the different providers end to end need to do. And how do we manage that within the framework of instant, whatever that is, seconds, minutes, et cetera. But that will ultimately slow down many payments until we have a more, I think, clear definition of whether or not all payments must have the same level of due diligence. A payment for $10 as opposed to a payment for $1 million. In some ways, from a compliance perspective, that's the very same payment. And so, when you're asking a bank in the middle of Kansas to accept an incoming, instant payment from, I'll say, Kenya or vice versa, how does the bank in Kansas know anything about the sender in Kenya, right? What can they truly do here to assess that payment? Those are my sort of top two. I don't know if others want to add anything.
I was going to say, I think Arunje in the report mentioned a lot about tokenizing compliance. I think that definitely is an area to look into and see how that could impact the speed that you've mentioned with, you know, the customer due diligence that's needed on both sides of the transaction. But Arunji, back to you.
Yeah, absolutely. And I think, you know, we've seen the simplified due diligence in some markets domestically where, you know, up to certain amounts, you know, it is simplified. But you know, I don't believe it's the case cross-border, and so maybe that is something also that could help facilitate these IPS systems connecting to each other, because for sure the compliance burden is still going to be high. You know, we have only a few minutes left. We had actually a number of questions, and I think we might be able to take a couple very quickly. So I think one of them is like the centralized threshold limit and management at country level, you know, is part of one of the building block 8. So I think that is apologies. Actually, we will, Rob, I see that you asked that question. We'll get back to you on that. And that might be a little more complex to answer in the time we have left. So I want to just ask each of the panelists for your view in one word of, you know, what you believe. So there's technology today, the blockchain and the crypto world in remittances is, you know, touted along quite a bit. And, you know, there have been some success stories and some not so successful. We are in a crypto winter, or maybe some even call it an ice age. And so, you know, it would be interesting to know from each of you, you know, what do you believe, whether it is hope or hype, you know? So in one word, we'll go around the panel and you can say whether, you know, what you believe it to be.
I can start, given you already blamed me for going rogue. I will answer it in one word, but I want to caveat, because I think is always the problem is when you associate crypto, people immediately sort of start to say, oh, well, that's, you know, all the bad stuff comes in. So I would encourage people to look at digital assets as a way to transfer value on blockchain and not worry about crypto. You know, we can have a whole separate discussion on crypto. So I think if we take that as a premise, this was probably 2 words, but extremely hopeful.
And I will second that, Mohit. Absolutely. I think it's hope. And if anything, it's true that technology can do things that perhaps we haven't thought of it in the past, which can have positive impact in the life of our consumers. But yes, there are risks. And I think it's our capacity to really manage the risk and leverage what innovation and technology can bring. That makes me hopeful.
And I also think that, I hope that will be successful in the long run. And I want to use it because it will be really convenient to send money from countries using crypto asset. And so, I really think, I hope.
Agree completely. Hopeful.
Right. So we have a unanimous panel, optimistic with hope, whether, you know, so that's, you know, really warms my heart to think that we could get there. We're at time. For those of you who send in questions, we will provide written responses and share along with the recording of this webinar. It really leaves me to thank my panelists here, and thank you, each one of you, really for taking the time to join this webinar. Very early for you, Elizabeth, and very late for you, Ryuichi, in Japan. So like across all the time zones, and some of us in the middle. So, and lastly, thank you all, for all of the participants who joined the webinar. Thank you so much for joining and staying to the very end. Thank you so much.
Thank you
Thank you
very
very
much.
much.
Bye-bye.
You.